can you imagine investing in a company with no business operations whatsoever? Well, some investors do just that. It's called a special purpose acquisition company, or SPAC for short. And investors literally put their money into a company with no assets whatsoever. So that's why it's called a blank check company. And you say, why would anyone do this? Well, here's how the steps of how this works. So the SPAC raises money through an initial public offering, right? So they get money and they take the money, they put it in an interest-bearing account in a trust, okay? So they can't touch most of the money that they got from the IPO. Now you say, okay, well, what are they going to do with this money? Why would anyone give them money in the IPO? Well, what they're doing, so this SPAC is then going to look for a company that they want to acquire. And now they might be looking at a specific industry. Maybe they want to get into consumer goods and they're trying to acquire a consumer goods company, or maybe they're open to any type of company whatsoever. But basically they are intending to acquire another firm. They're going to merge with that firm, and then you're going to have the combined entity, and then the SPAC is going to disappear, and typically they would take the name of the company that they have merged with. Now, if they can't find another company to merge with, and usually there's a time horizon of like, let's say 2 years. So if they can't find another company to merge with within 2 years, then they just have to give the money back to the investors. And the investors don't get 100% of what they had invested because there were some costs involved and so forth with the registration process. Okay, so why would anyone do this? What is the purpose here? Why wouldn't you just go and buy a private company and take it public? Well, the benefit here basically of this SPAC is that the IPO is easier to do when you have the SPAC that doesn't have any historical financial results. They don't have any assets that they need to make disclosures about. It's really easy compared to like if you were to buy a company that had been in business 30 years and had all, property, plant, and equipment, and tangible assets, all these different things you need to make disclosures about. It's much easier to go public with this shell company. Okay, so the SPAC is just a shell. And you say, okay, it's easy. We'll just go public with this, and then we'll go find the company that we want, and we'll merge them together. And then, so instead of the alternative is if you have found this company, let's say you've had a target company, and you didn't do this whole thing with the SPAC, and you just said, okay, I just find this target company, and I buy them, and now we're just gonna take them public. Well, they say, okay, well, what are all the prior financial statements for this target? Let's look at their assets. Note 1. Note 2, and so forth, all these disclosures. You don't have to do that with the SPAC because the SPAC is just a shell. It's just there. It's like a holding place for you're ultimately going to acquire this other company. Okay, so I'll give you a real life example. So this GS Acquisition Holdings, they raised almost $700 million through an IPO in 2018. So GS Acquisition Holdings, that is the SPAC. Okay, and then they had to file, because they were going public. When you go public in the U.S., you have to file this S-1 registration statement with the SEC. Okay, so this is just the shell. This GS Acquisition Holdings, they don't do anything. And they even tell you in the S-1, it says we have no operating results. Okay, they're not going to do anything until they get the money from the IPO, and then they're going to go out and try and merge with another firm. Now, they didn't know what firm they want to merge with. They said we have no plans or understandings of any prospective target. So they didn't know. It wasn't like they were saying we're going to go with this specific firm. They're going to get the money, and then they're going to go and look at different firms and see ultimately who they're going to merge with. Okay, and again, if they can't find anybody, then they won't merge at all. Now, they were targeting specifically, they wanted an industrial company, and they ended up finding this company, Vertiv, which basically they manufacture equipment for data centers. And so they ended up merging with them. And so the combined firm, so then the SPAC, the GS acquisition, and that just disappears. When you have the merger, they merge with and now the combined company is called Vertiv Holdings, and it began trading on the New York Stock Exchange in 2020.